What I want to do here is sort through sort of the noise to get the signal. And so give me sort of your take on the last week or so in markets, volatility, some of the themes that are coming out of it, and how you were positioned going into this last few weeks.
So it it really goes back to how I was positioned coming into the year because I do a top five picks for CNBC every year, and this year I led off with cash as being my lead pick, invested in money market funds that were yielding 4%. So, and the last time I picked cash was 2022, and the S&P finished down 19%. So, unfortunately, a lot of what I was worried about has sort of come to pass, and it's a combination of headlines coming out about obviously the tariff situation is not good. The reciprocal tariffs were way worse than anybody anticipated. Thankfully, President Trump reversed course and just put 10% on all countries except for China, which is obviously over 100%. Um, that's not good, but that forced a rally of 9.5% or so on the S&P 500, which is one of the nine best going all the way back to the 1930s. But the market has started to give some of that back, obviously, over the last couple of days. And the bigger issue is, quite honestly, the bond market. And I know CNBC spends and all the financial networks, people have 401ks, et cetera, and they look at the stock market and like that's what they're focused on. What they should really be scared about is that the bond market in the last 5 days, the 10-year treasury yields have gone up from about 4.0 to 4.5%. Normally what happens during times of turmoil is people sell stocks and they buy bonds. The
Mhm.
last time you had this kind of huge move up this rapidly in a week was during the global financial crisis. So, and the bond market is about 30% bigger than the stock market. Because if you think about it, right, companies are public, but a lot of companies will have credit lines, they'll have borrowings from their local bank, et cetera, whether they're private or not. And then obviously the public companies
Mhm.
too. And so that's why the 10-year treasury yield in particular, the 30 years doing the same thing, where it's up about 50 basis points in the space of 5 days. And, to compare
Right.
that, for those of us who kind of focus on credit metrics a lot, like I do, you go, wow, the last time this happened was during the global financial crisis. You worry about something's going to break.
Right. And that's key, right? Something could break. And so when we talk about sort of noise versus signal, the equity markets is a lot of noise. You talked about that big, rebound for one day, but if you were asleep for that whole day, you may not have even noticed because the bond market has been more consistent. There's also the dollar, right?
Yeah,
Which the dollar index, and it seems to fit into this trade that we're hearing more about, which is sell America, right?
yeah,
That's the
yeah.
signal we're getting from the bond and dollar markets, credit markets. Talk a little bit about that, what you would take away from this week, and given what we've seen from the Trump administration on tariffs and their willingness to sort of endure this kind of volatility in markets.
Yeah, Deirdre, it's a fantastic point because you're talking about bonds, but on top of that, if you think about it, the U.S. has got the biggest stock market in the world, the biggest bond market in the world. So let's say you're invested in the U.S. and you're a foreigner, and there's a lot of foreigners, obviously, that own our treasuries as well as own our stocks. The other thing on top of this, as you rightly brought up, is the U.S. dollar has gone from about a buck 10 at the early January. Now it's down to a dollar, basically. And so if you look at that, that's a currency weighted basis. You go, okay, so not only have I lost whatever it is in the bond market and the stock market, but if I'm a foreign investor, I've also lost in the currency translation in that the dollar is weakening. So it's gone down about 10%. So you can add to the losses that you have in your bond and stock portfolio another 10% in losses because that's in US dollars. And if it's not hedged, you're getting hit on that on top of the losses you've already had. And
Mhm.
so that then feeds people who own our stocks and bonds to say, oh my God, I'm getting killed twice. Let me delever. And that's also part of this that people aren't necessarily aware of. And one of the things that kind of troubled me going into this period of time is they talk about, well, hedge funds and big financial institutions, they took their net exposures down. And in plain English, what that means is that what you're long minus what you're short, that number is moved lower. The problem is if you're getting that net exposure down by increasing your short positions, your gross exposure, so your how much you're short plus how much you're long, is going up. And for those of us with long memories, you sort of think about long-term capital management where you've got, a couple of Nobel Prize winning laureates that think that you can't get hurt when you're levered up and you've got all these positions that supposedly offset each other. But when you go
Hmm.
to big unwind, everybody's unwinding the same stuff at the same time. And if you have a lot of leverage, that's what causes big things to break. And so that
Which is
concerns me when I look at all of this stuff put together.
which is why your cash position at the beginning of this year now looks so good because you are actually not in that space. You've been holding on to cash, which doesn't need to be unwound. You're holding on to it. Do you think that this plays out in a similar way as 2022? Worse, better? What are you doing with that cash now that we've seen markets, the equity markets come down so much? Is there opportunity?
Yeah. So let's talk about the last thing we haven't talked about, which is valuation. So
Hmm.
I listed out three reasons I liked cash coming into the year. The first one was valuations, because if you look at where inflation was and you look at that relative to history, you say, okay, let's be optimistic and say it was between 2.5% to 3% coming into this year, which actually was a little bit higher. But being an optimist, let's say that that's where it was. That means that the trailing multiple on the S&P 500 earnings, and I look at trailing because as you're seeing right now, earnings estimates are getting cut pretty aggressively, right? Um, Trailing, at least you know what the numbers are. And so
Right.
you look at trailing estimates, you go, the S&P was trading at 25 times. The normal level is 19 times. So you could have argued the market should have been down, could go down 30% from those levels just to get back to an average PE. If you go into a recession or stagflation scenario, you're talking a mid-teens multiple. And so you can do the math on what that would mean going from 25 times to 15 times. And so on top of that,
Mm-hmm.
obviously, you're going to have earnings estimates coming down. And people thought coming into this year, the S&P 500 would see earnings go up over double digits. Now,
Right.
the other
And
issue,
you're seeing companies start pulling their guidance even at this stage. Dan, talk a little bit about tech valuations and fundamentals because we sort of ran the calculations on TechCheck earlier this week, and basically we looked at forward price to earnings ratio, but that AI premium has essentially been erased for companies like Google, close to being erased for Microsoft. For Nvidia, it has been completely. Is that the right metric to look at? Do these become appealing, or like you said, is it better to look at the trailing 12 month?
yeah, forward, I never look at forward 12 months. Doesn't matter. When stocks are going up, people like to look at that because it makes them
Yeah.
feel better. And you said one thing, that earnings estimates are getting cut now. They've actually been getting cut since the middle of last year. So if you go back and you look, S&P 500 earnings for this year have been coming down since the middle of last year. Why? Because the biggest companies in the world, a lot of them have been cutting. You go back and you look at the June quarter of last year, Microsoft, Google, Amazon estimates, the three biggest hyperscalers in the world, all had their revenue estimates for September come down after they reported the June quarter. Tesla's estimates have been coming down since 2023 on the top line. They had their first down delivery year in over a decade last year. But when the Fed is cutting, don't forget you had that going on. Stocks are going up, and people can say, "Oh, I think Tesla is going to be worth 2 trillion out in a decade because of robots and this and that, and AI is going to be huge and in a decade." And so I got to own that. And for those of us with longer memories, we go, "Well, that's a lot of what people were saying in 2000." And then the
Hmm.
Nasdaq went down 78% because you way overbuilt capacity for the internet. Estimates got absolutely destroyed in 01, 02. And the Nasdaq went down 78% from peak to trough, and it took you 15 years or so to get
Hmm.
back to those prior levels. So that's why looking at forward estimates, I know everybody likes to do that because it makes you feel good, because it looks like the PE is low. But the problem
Right.
I have I am in, I would be shocked if Nvidia makes the consensus forecast for the year, because that when chips go on short supply, companies overorder what they need. In addition
Yeah.
to that, you've got tariffs coming. So then companies are going to overorder because of the tariffs. In addition to that, if you're a foreigner, especially China, you worry that you're going to get sanctions put on you. So you're going to overorder because of that.
And
That's
this
what,
is the idea of stockpiling.
yeah, you're stockpiling. And so now at some point, you're going to come to the other side of that and you're going to have an issue. And to pick a recent example, following COVID, if you remember, NVIDIA's revenues were down year over year in 2022 by about 20%. Then ChatGPT came along and revenues went, sorry, then COVID came along in back in 2020. Sorry, I'm getting the timelines here backwards. But before COVID, NVIDIA's revenues were down over 20%. Then
Yeah.
COVID came along, revenues went up over 80%. Then on the other side of that, when supply was available, the revenues again went to down over 20% prior to ChatGPT. And this is year over year numbers I'm talking about.
Hmm.
Now they've taken off again. And my point is, if you go back and you look at COVID, you can see how fast the revenues went from being up over 80% to down over 20%.
Right.
Supply got normalized. And so
The,
my point is, we've seen this recently.
Though I think many people are arguing that AI is different. This is existential. It's a different shift than anything we've seen before. And Dan, I know actually you've also been vocal in calling for this digestion phase for AI, which we're seeing signs of. I mean, you see it from Microsoft, the LinkedIn post from the executive, the $1 billion delay of data centers in Ohio. We're going to let you get back to trading because I know this is the end of an absolutely busy week. But thank you for your insights. We'll get to the sort of AI side of this and digestion versus CapEx, all of this picture another time when you come back. So thank you.
My pleasure, Deirdre.